joining us today. We've received an incredibly positive response to our webinar series where our senior leaders and subject matter experts share their knowledge and insights on the cooperative model. These live sessions are being recorded and shared with our members and stakeholders both here in New Zealand and internationally. Actually, there's been quite a lot of uptake of them internationally, so I think people do look to New Zealand to see what we're doing here and learn from that. Today, we have the pleasure of welcoming Ross Verry, CEO of Syndex. Syndex is an online platform for registry management solutions, a member communication system, and a marketplace. Syndex has been a corporate associate member of nz.coop for 4 years, offering cooperatives access to capital and member access to liquidity where required. Ross comes from a banking background and finance background where he's had particular exposure to the primary sector right across the value chain. As a professional, he's advised and provided services to both co-ops and member-leading teams that are charged with developing capital solutions. Ross has either held or currently holds governance roles in private farming businesses, entities providing services to the primary sector, and cricket. Today, Ross will discuss options for accessing capital as a cooperative. What are the pros and cons of bank debt? What are the other options available and how they'll work within the cooperative principles? I'll just admit someone sitting in the outskirts there. We'd like to make the session interactive, so please submit questions during the session using your chat function. You can do it anonymously or put your name up, and I'll basically raise those as we go along so we don't have the feedback. We'll have time for a live Q&A at the end of the session. We're sort of expecting this event to take probably 30 to 40 minutes, and so we'll be wrapping up. And I'll now hand over to Ross. Welcome, and thanks for joining us, Ross.
Well, great. Thanks, Ross. Hi, everyone. Hope everyone can hear me all right. I guess, as Ross said, look forward to questions. Just certainly pop something up on the chat board as soon as you think of something. But I'm also conscious that I'm not the only expert on the call today. So when we get to the end and there's some questions, quite happy to just have some discussion as well, because it'll be good to get at other people's perspectives as to what they're seeing in the marketplace. But accessing capital, I suppose, is very topical at the moment for a number of reasons. One is, I suppose, over the last couple of years, starting early 2020, there's been a lot of businesses that have had a real need for capital in terms of helping them survive. But there's also been a lot of businesses that have had rapid growth opportunities, and to execute on rapid growth opportunities, you do need to access capital in more cases than not. So we've seen a lot of activity across lots of different markets, but I suppose and it's certainly the area that's our business focuses on, and it's the area that I've always been particularly interested in. Privately owned businesses have probably been more active in the capital markets than ever before. Private capital markets are certainly growing, and I'll talk about that a little bit more. Historically, it's been difficult or more difficult for private businesses to access, let's say, public investment or public money without compromising the benefits of private ownership. Whereas now, there's potentially other structures developing, or even just other attitudes developing towards, let's say, having or accepting external investment into private businesses. Now cooperatives, I guess, is a subset of private businesses, and they've got perhaps some additional challenges to accepting public money, and that organisations are largely owned and controlled by members for the benefit of members. So you probably have to think a little bit differently, as do potential external investors, about what it means to introduce or accept external capital. There's certainly some solutions. When I think about capital providers, they look at a number of fundamentals of businesses when they're making investment decisions, and ownership structures, need not preclude them investing their external capital in some form. There's a number of things that they'll think of. I suppose one of them, which would perhaps address a little bit later as well as some of the others, is that they probably will want to know how they can get their money out. They'll make decisions, obviously, about the benefits of getting their money in, but a really important part of an investment decision is how they get their money out if they need to, if they want to. So I suppose in the course of this next 35, 40 minutes, we'll talk about some of the, I suppose, more innovative options that we're seeing around the marketplace for investment into private business and cooperatives, and also talk about some of the very simple ones as well, which are often where the obvious answer is. But before I start, I just sort of make some opening comments on the investment environment, and again, it'd be interesting to hear other perspectives, perhaps later on in terms of what they're seeing. But firstly, it's still a pretty interesting global and local economic environment, I think. There's obviously large parts of the global economy doing very well, and I think of something like the tech sector, where there's just been, I suppose, an explosion in asset prices and activity. And look at the local economic environment as well, and a lot of the economic commentary is talking about a very strong economy, to the point, well, who would have thought this 12 months ago, where there's potential to see interest rates rising. So look, that's fantastic, and I suppose long may it continue. We obviously feel for some of those businesses that are doing it a little bit tough because of the general global situation and the pandemic. But I do think that there are still clearly some risks out there, so there are some challenges. Just today, listening to some of the economic commentary on breakfast television around logistics, getting products into the country, out of the country, the supply chain. That's clearly going to have some impact. It looks like it's already having some impact on inflation, which certainly isn't a great thing for the economy, and just I suppose the downstream effects of things like that we're possibly yet to see. So as businesses, we all need to, I suppose, be cognizant of some of these risks, and that might influence you in terms of your thinking on, what your capital structure or your optimal capital structure might look like, and therefore where you might access capital from. The low interest rate environment has meant that investors have been, I'll call it very, very sort of active, and they've been thinking about different options in quite a different way than what they might have done over the last or the previous few years, in terms of where they can best put their capital to work. And indeed, sort of globally, probably going back a little bit further, investors have been allocating more and more of their portfolio to what we'd call alternative assets. And by alternative assets, we really mean assets that aren't sort of listed markets, corporate bonds, the government stock, those sort of things. So what we're talking about here in the alternative market space is things like private equity or private business investment, private credit, which I'll talk about a little bit more later on, and real estate. And in New Zealand, we've seen it, manifest in different ways. I mean, there's been a lot of money going into private equity funds. So you're probably aware of a number of the private equity managers around the place. Names like Pencaro Capital, Pioneer Capital, who have invested in private companies historically, putting money in to help those businesses execute their strategy, or private businesses execute their strategy and grow their business. And they will have a certain amount of influence and skills to bring in terms of growing those businesses. And they'll potentially be there for a period between 3 and 10 years. We've seen a lot of proportional investment into property syndicates. That sector has grown hugely, and that's provided some really good opportunities both for investors who like bricks and mortar, but also owners of businesses who have been able to release capital from some of those assets which they may not necessarily need to own. So property syndication has grown hugely. We've also seen, particularly over the last year or two, actually, a lot of proportional investment into agriculture and horticulture. And again, that's either people taking up the opportunity to invest into land that might grow trees or grow grass, and lease it to experts who can, either turn that grass into protein, or grow trees on the land and sell fruit into the international marketplace. So those have been really popular asset classes. And the other one which has really, I guess, popped up quite markedly over the last year or so in New Zealand is private credit, and that's where investors they will pull their money into a fund, and as opposed to that fund perhaps investing into a business as an equity holder, they will lend money to a business, and there's a number of those sort of funds just starting to develop here, and I think people are seeing that there's an opportunity to operate as a lender, which puts you in a different position to an equity holder. You've got a slightly different view to perhaps a bank, and therefore you might get access to business that banks aren't as attracted to these days. So that's just an opportunity worth thinking about, I think, for all private businesses now, because it appears to be that privately owned businesses is and I'll call it a sort of sector where those private credit funds or private lenders are looking to get more exposure to. For them, like a lot of us, there's a lot to like about private ownership structures. And they might not be able to get exposure as an equity holder, but they can get exposure as a lender. So they're still getting a return from the private businesses with the investment fundamentals that they like. So that's just a little, I suppose, overview of some of the things that I'm seeing in the market which are worth thinking about. I think, as businesses, there's a number of things that we think about when we're introducing capital, whatever form that might be in, or when we're accessing capital. And I suppose, some of these are more, I guess, important for cooperatives than other organisations. Some are less, but for example, by introducing new equity, as an example, you need to think about the level of control that you might want as an owner or a group of owners, and what you're prepared to give away. That could be in the form of well, voting control or otherwise, but it could also just be in the form of something like board representation or management input, which some investors might see as very important to them. There might be other strategic impacts, positive or negative, and these are the sort of things that we think of, both as I suppose an intermediary, but even within our own business. There's we have a term that we use around smart capital. So not only are you getting investment from a certain party or group, but you're also getting some really good experience, some networks, some access to markets which you might not otherwise have. So that's sort of really positive. I suppose there's other impacts, and you could regard these in any number of ways, but there might be partnership agreements or investment agreements which have an element of exclusivity around them. But I guess what I'm saying is that there's a number of options, whereby not only you're accessing capital, but you're accessing an opportunity to grow your business through the association with an investor or a group of investors. And I suppose the investors wouldn't be doing it unless they were thinking about either growing their own wealth or growing their investments, which you will contribute to. So opportunity for a win-win situation there. I suppose the other things which were important to think about when you're introducing new capital investors, there's going to be an increased administration in one way or another, and there's going to need to be a focus on investor relations, and how do you manage those things? And of course, the first thing I'll tell you is come and see Syndex, but I think it is really important because when you introduce new investors, new investment, they clearly want to understand how their investment is performing. And you want to be able to inform them how their investment is performing, because there's going to be a time in the future where you potentially sort of need them again, and they're going to be more likely to continue their support if you're able to sort of demonstrate very squarely the performance of the business and what they've got to look forward to. And of course there's costs. Everyone wants a return on their investment. It doesn't matter how they're or what form or what structure they're providing that investment, but that's something that you'll need to consider. So as I talk about some of these options, I'll address where I think the different options sort of can contribute to those factors that I've just talked about then, and you'll have your own views as they apply to your businesses. So I'll probably start with, I suppose, what I see as the what is historically the most logical and simple forms of capital to the business, and that what we would see certainly on our platform is particularly in growing businesses, what they are looking for and often looking for is access to equity capital. And I suppose there's a number of reasons why equity is perhaps more attractive than debt, and why it's more accessible than debt. But I guess when it comes to a number of cooperatives, there are some little fish hooks with equity, and it comes back to what the cooperative is there for. A members' organisation being run for the benefit of members. So that introduces some challenges to introducing outside equity. And look, I know every organisation's slightly different, so I'm not going to generalise, but I guess what you would say at the very minimum, if outside equity was to be introduced in some form or another, it's really critical that there's philosophical and strategic alignment there. Again, at the very least, for sort of investors to be involved, and that actually applies to any business, not just cooperatives. The alignment and strategic, I suppose, understanding of the investors with the existing investors is really, really important. Look, there's always the opportunity to invite more members and attract more members, either I suppose from outside cooperatives, bringing new people in as they see the benefits of being a member of a particular cooperative, and when it benefits the cooperative itself. So that's certainly possible. There's also the possibility of increasing the contribution from cooperative members, and that could be aligned to the usage of facilities as an example, or to the benefits that all the different members get, you're sort of seeing I suppose a very robust discussion around Fonterra right now as an example. And I suppose that sort of introduces one of the reasons why perhaps asking for increased contributions from cooperative members is challenging in terms of sort of increasing equity or raising capital. And that is that when you're asking members to provide equity, I suppose that means that that they can't do something else with that money, and that something else is probably most likely to be investing in their own business. So I would say that most of the cooperative members would have I suppose a very strong level of confidence about investing in their own business and what returns that might drive for them. And I guess referring to the dairy sector again, there's clear benefits of being a member of a cooperative, but there are still always going to be some members who might decide that they would rather sort of redirect that investment to either their own business or to an alternative, or to save the money and supply, in the case of the dairy sector, to a corporate that doesn't require them to own shares and invest capital in there. So I suppose those are some of the pros and cons that there might be, or things that both issuers, which I'll in this case is the cooperatives, or investors, would think about when we're talking about an equity investment into a cooperative. So I suppose if we're addressing the factors that you might want to consider, certainly around flexibility, if you're able to raise capital from your own membership, that's a good thing. You're not going to lose any control. Unless there's a very, I suppose, significant investor who is able, under the capital structure, to make a significant investment, there's unlikely to be a requirement for board representation or management input. There's probably unlikely to be any other massive strategic impacts from just having more members, or members paying more. You certainly might get some what I call non-tangible benefits from getting some new members. Whether or not they demand or ask for board representation or management input, you might get access to some really good experiences or networks. But you will, on the other hand, if you introduce a whole lot more new members, you'll just need to up the ante on that administration and investor relations proposition. And I suppose the other thing which is relevant for any business is that equity is probably going to be the highest costing capital that you can access. Right. So feel free to pop through any comments or questions at any stage. I suppose the next thing I was going to talk about was access to debt, and following on from what I was saying earlier, I've put my next sort of bullet point as being bank or non-bank borrowings. I suppose the banking environment is pretty dynamic and has been over the last sort of, I suppose you'd say, 5 years. What we've seen, since the GFC and it's ramping up all the time, is that the banking sector is one that's increasingly regulated. Banks are certainly required to exercise a lot more diligence over their lending portfolio and different sectors within their lending portfolio, and they need to allocate capital accordingly. And I suppose what we've also seen is the regulators, being very targeted in cases as to what they're looking at and what they're looking for, both across the banking sector more generally and within individual banks themselves. And so what you've seen in some instances, for example, is that there's going to be a much higher allocation of capital across some sectors than there is in others. And the most obvious example in the current market is that that mortgage lending, because I suppose there's a very liquid underlying security supporting the lending, it has one of the lower allocations of capital. Agriculture, as another sector, has over the last few years started to attract a much higher allocation of capital as demanded by the Reserve Bank, and that's actually getting higher. So what that means is that sometimes credit is actually less available in certain sectors. And again, I highlight agriculture as in sectors within agriculture, where there's been, an active a strategy to reduce bank exposure to some sectors, and even if they're not reducing their exposure to a particular sector, they might be increasing the cost of that sort of lending to reflect the fact that they have to allocate more capital to the sector. And we've seen a little bit of that type of of outcome in property development as well. So there's certain types of property developments that attract a much higher cost of capital, therefore the allocation of funding available for that sort of activity is, I'll call it rationed, and if not, it becomes more expensive. Having said all that, bank funding is probably the cheapest form of capital that businesses can access, but it does require a certain level of credit quality, and what banks look for, they want to see evidence of a strategy, a good plan. They want to see profitability, or if not profitability, certainly an ability to meet interest and principal repayments over a period of time. And certainly in some sectors they want to see what they would regard as a satisfactory level of equity that's already in the business. So cooperatives are really interesting, and it's probably hard for me to say there's a very consistent view as how bankers see cooperatives, and I know we have Rabobank, which is a cooperative itself, and very large lender to the agricultural sector. So I'd expect take a very sort of strong view on the credit, credit quality of co-ops and some of those real key fundamentals which they would regard as positive, because they've got a really good understanding of the model. But I suppose there are some contrasting views, and there might have been a time where bankers saw, because cooperative members were very committed to the organisation, that they could potentially provide let's call it a second or third way out. So if the business was unable to pay its interest or meet its principal repayments as scheduled, that there was a really strong committed ownership group that could contribute to restoring the credit quality and the ongoing banking relationship. Perhaps in some areas that's changed a little bit, and coming back to an earlier point, that there could be a view that the cooperative members are more committed to their own business. So if they do have spare capital, they're more likely to plough it back into their own business than into the cooperative, to sort of keep that I suppose capitalised to the right sort of level that makes a bank comfortable. I think the other thing that banks might look at, and this could go for any investors potentially as well, is that often the banks or capital providers might be funding a certain type of asset. In some cases, that type of asset is very, very specialised, doesn't necessarily have an alternative use or an obvious alternative use. Therefore, they will reduce the, let's call it the security value of the underlying assets of the borrower. So I just mentioned security, and that's something that's to be considered. That banks, any lenders, in fact, will generally require some sort of security over assets. They might introduce a series of financial or non-financial covenants that lenders need to operate towards. So that could be interest or debt servicing covenants. It could be minimum equity levels. Could be sort of other non-financial covenants. And one example of that in the agri sector is you need to meet certain environmental standards, which is probably fair enough. One of the things, I guess, that also pops up from time to time is that the bankers might also require shareholders to contribute to the capital requirements. So let's say there's a growth requirement of or a sort of growth opportunity that requires $1 million of funding. It might be the banks will say, yep, we'll contribute 80% of that, but we want to see 20% contributed by the shareholders or by a cash contribution from the borrower. That's whether it be cooperative or anything. And I suppose what that is doing is just assessing the overall serviceability of the debt by that organisation. So if we look at sorry, before I move on, probably just a couple of other things. One is that clearly bank funding has a shorter tenor or commitment than what equity funding might have. So you're probably unlikely to see a bank funding facility these days go much beyond 3 years. Certainly not 5, I would say. So there's always going to be a refinancing need at some stage in the nearest future. But the other thing that I just wanted to reiterate is that we are starting to see those the emergence of non-bank lenders or funders, whether it be a fund or whether it be some individual. I'll call it high net worth or very high net worth businesses that see an opportunity to lend, to what they see as good businesses that they might otherwise not have an exposure to. Look, they might be more expensive than banks. In fact, they're more than likely to be more expensive than banks. but the flip side is they might offer a little more flexibility. And so that means they might lend more. They might not have quite as many or quite as tight financial covenants, and they might lend for a longer time. In fact, often they will, because they see the opportunity as an investor, particularly in a low interest rate environment, to say, right, I think I can lock away a return of whatever that might be for 5 to 7 years, and I don't have to think about where I need to put that money to get a return for that period of time. So those are the sort of things that are worth investigating more, because there is more opportunity than it would have been 3 to 5 years ago. So in terms of bank funding, and I talked about the cost being the lowest cost of capital, generally. Look, as long as you're repaying your debt and meeting your interest requirements, there's certainly very little loss of control. Hopefully your bank does take a strong interest in your business, but very unlikely that they're ever going to have to take board representation or provide managed input unless things are going badly wrong. And they're not going to provide a whole lot of strategic input. They might bring something in terms of some, I'll call it banking knowledge, banking products. They would generally, I'd like to think, hope that your business will grow and will be thinking about how they can help you grow. And of course, you're just going to have a relationship with your banker. There's not going to be a whole lot of people that you individually communicate with, as investors. So the administration and investor relations piece is going to be very low touch. So
Ross, just to interrupt, sorry, we've received a question here. Ross, have you seen land-based co-ops offer sidebar syndicated opportunities to their members where the cost of land is otherwise prohibiting growth?
Look, I mean, I think that, I think I'm answering the question correctly, but I think that external investment into land has become a very, I suppose, legitimate way of accessing capital to grow business. And I sort of think about, private business owners are starting to look at things a different way. Particularly as the cost of land has increased over the years, and in the agriculture sector, the cost of funding and the availability of funding out of banks has become more challenging. And so business owners, if they're good operators, they sort of sit back and think, well, I could put a whole lot of capital into buying more land, even if I could access the debt. But where am I going to get my better return on capital? And it's probably going to be, let's say, operating the business as opposed to sort of owning the assets, which are very capital intensive. So I think that that there's been more and more intermediaries who have looked at how they could facilitate that type of land ownership and that type of I suppose operation. And I generally think it's a good thing, because what you're able to do is you're giving really good operators the opportunity to farm good land where everyone gets a return from an investor point of view. Not all investors either understand or want exposure to, for example, commodity risk, operational risk. They're prepared to take a sort of lower, more consistent return on just owning the land, knowing that there's a good operator on the other side of the deal who is going to pay their lease every month. Hopefully that's answered the question. Sort of almost precursed one of my last points, but but in the meantime, I've got another category of capital, and I've called them hybrid instruments. And the reason I've called them hybrid is because, you know, it's not necessarily lending and it's not necessarily equity, but they're instruments which provide capital to organisations and investment opportunities to investors. And it could be a capital note, could be debentures, it could be RPS, being redeemable preference shares, or other similar type of products. And what we would normally see is that these hybrids would rank behind the secured creditors and probably rank behind unsecured creditors, but would rank ahead of equity holders in the event of a business being wound up. So so that sort of drives the return that that investors, you know, might expect to receive, on the basis that that they're taking a little bit more risk than a banker, a little bit less than an equity provider. So you know, when it comes to cost, they're going to be more expensive than debt, but probably lower than equity. I guess the other advantage is that you know, you're more likely to be able to issue them to sort of, you know, non-members as well as members. You certainly wouldn't expect them to be, you know, voting instruments in terms of the direction of the business. But it's really interesting for an investor because if I think of a lot of the different you know, sectors where cooperatives operate, it's an opportunity for them to invest into an industry where, you know, it might otherwise have been difficult. And I sort of think of things, you know, and I'll use again agriculture as an example. And you know, historically, there's been very little opportunity to invest in agriculture. You know, in the public markets, there hasn't been many public stocks there, and you know, some of them have actually had a reasonably checkered history. And a lot of I suppose the success stories in New Zealand agriculture and horticulture have actually been privately owned. So so here's a way that investors who really want exposure to a particular sector can get in there and invest some money. And I suppose the other reason why investors might be interested, or a group of investors might be interested, is that they could be out of the sector, you know, themselves. They could be operating a business within a sector. They're a member of a cooperative. They've got some spare cash. They could put it in a bank, of course. They could put it in the share market, of course. But then they could put it into an instrument that is contributing capital to a cooperative that they know and an industry that they know well. So, you know, these hybrid instruments, as I said, they're more likely to return well, they're more likely to provide a return which is higher than what people would get in a bank, with perhaps less risk than what they might, you know, be exposed to in the share market, in an industry that they understand. So it's you know, really a fantastic opportunity to put their money somewhere, diversifying a little bit away from their own business, but into a sector that they know and love well. We've done at Syndex, we've just been doing a little bit of work in Australia with cooperatives in Australia, but what we've found there is that the Australian you know, cooperative environment has a regime that allows for cooperatives to issue what they call cooperative capital units, which is issued under a separate piece of legislation from you know, what most other issuing organisations in Australia issue under, which is the Corporations Act, which is pretty similar to our FMCA. So I suppose, you know, what we're seeing, you know, perhaps in other environments, and something we should think about ourselves, is other innovative ways for cooperatives to get access to capital. Look, now I think that it's probably also important that you are dealing with a different set of investors than the bank. But I think the investors would generally want to see evidence of a strategy of profitability, or that ability to meet interest and to pay back the money at the end of the term. And they will have a high expectation of receiving good levels of communication, performance reporting, and to ensure that they know exactly how much their investment is, how much their investment is worth, and how much they've been paid along the way. So that sort of investor relations, good record keeping is absolutely critical for this group of investors, and they'll also have a view about what an appropriate return is. So look, I think hybrids, and we've seen some in the cooperative sector already. I think there's really good opportunity to look at different types of offering for different groups of investors. Look, they may want, as a group, some form of board representation and input into how the business is run strategically. That's not a given, but it is possible if it's a significant contributor to capital. But apart from that, I expect those or that group of investors to be less active than obviously a group of ordinary shareholders. Possibility that some of these people again will bring some smarts with their capital, but overall really legitimate type of option for people to consider.
Ross,
I think that's
yeah, I've got a question here about are you aware of the Cooperative Bank favouring lending to cooperatives in any way? And I'll just extend that, because obviously you mentioned Rabobank, but there's also SBS Bank and the credit unions and building societies. So all of them operate under the cooperative and mutuals principles.
Yep. So I couldn't talk specifics on them. I am most familiar with the Rabobank business model, given the background. But yeah, I mean, as far as specifics and policies with respect to cooperatives lending to cooperatives, so I don't know specifics of lending policies.
We've got another question here. How would a co-op go about investigating a hybrid investment option?
Oh, look, I think it's really important to take independent advice on these sort of things, and that can range, and again, depending on what type of investor you want to access. If you want to access a group of retail investors, which you might want to do if you have let's say a large requirement, and you would probably want to start talking to let's say a broking group which has access to distribution to retail investors and can help you produce the documentation required to access those investors, which is I suppose a reasonably high level when you get, or a reasonably high level of disclosure when you get to that particular part of the market. Otherwise, accounting advisors would certainly have a view, depending on who your accountant is. I think obviously the sort of large accounting firms in that sort of middle tier, they will certainly have some views and some skills where they would be able to advise you. But there's also a number of, I would call them kind of boutique financial advisor stroke investment banks who have done this type of thing before, and done it quite discreetly, and can do it in a way whereby it might just access a small group of investors who provide a significant contribution. So maybe if I suggest if you have I suppose a particular requirement you might be looking for, and when I'm saying particular requirement, I'll sort of ask, how much money, what is it for, and what type of investors you might be, happy to sort of entertain. If you wanted to perhaps send that a note through to Ros, and I'll certainly have some views as to who provides that type of advice for that type of product. Okay, look, the last one I've kind of addressed in the question, but the concept of sale and leaseback of, I'll say non-core assets, but it could actually be core assets, is something that's, I suppose, become more, more evident across all sorts of different sectors. I mean, if you were to look across where a lot of investment money is going, or has gone over the last little while, when we look at that, what I call alternative asset classes, a lot of it has gone into, what I call more broadly commercial and industrial property. And certainly since the COVID time, when I'll call it logistics type assets, and assets that frankly we're managing or moving, for example, essential products or essential goods, and I'll sort of use industries like the food sector, construction sector, probably really good examples of that. And I suppose a lot of businesses, they will look at their asset register and make a decision on what they really need to own, and they'll use all sorts of reasons for that decision. I mean, there will certainly be control factors. I mean, there's some businesses that see some assets as absolutely key, that they have ownership, and that they can always move very quickly and move very decisively if they need to do something with those assets. There are others that say, look, we just want to ensure that we get access to a certain type of asset, which could be land, could be buildings, but we don't necessarily either have or want to allocate the capital to those, I'll call them capital intensive assets. And so that's between that desire or that strategic view and the appetite of investors to put money into, as I've said before, bricks and mortar and certain industries which they regard as really essential to the ongoing running of the New Zealand economy, for example. That means that there is an opportunity. If I look at agriculture as an example, I talked about land, and land being leased to high quality operators who get a return on their investments, and also able to provide a good and appropriate return to the investor. That's sort of one aspect, but the other area where we've seen quite a bit of activity over the years is in the I suppose services to agriculture, or those sort of downstream assets. So cool stores, pack houses, retail buildings that are related to the agricultural sector. A number of them are owned by either individuals or syndicates of investors who are getting a good return, or what they regard as a good and appropriate return on their investment, which they are leasing to an operator which they have really good confidence in. So I think we're probably still going to see more of that. I mean, there are some industries which are growing rapidly, and it's just not possible to access equity from members, for example. It still might be challenging for banks to get their head around such rapid growth. So they need to look at other alternatives, and the alternatives could be the hybrid instruments that I talked about before, or they could be looking at how they get access to the assets that they need to grow their business. And so once again, it's a reasonably cost efficient measure, I would say. Clearly, you lose ownership of those assets. Doesn't mean to say you'll necessarily lose control of the assets, because you can write a lot of things into agreements. There's probably not going to be a whole lot of strategic input or demands from those investors. But the other option, or the other advantage, is that you might get exposure to some sort of very smart people with some interesting ideas around how assets could be financed, and they might have a considerable network that I suppose as a business that is looking to grow, that could provide you with more options for access to capital. And I think the other thing, depending on whether it's a syndicated option or not, but whether it is or not, the administration and investor relations is going to be someone else's issue. It is more likely to be the syndicator or I guess the front man of the ownership group of that particular property. So really sort of, I suppose, growing in a legitimate way to access capital for growth of a business.
I'm just aware, Ross, that we're coming close to wrapping things up. Is there any questions out there from anyone that you'd like Ross to answer before we finish the webinar? You can either do it through the chat function or unmute and ask them directly. And just for myself, I guess, what I find interesting for our startups is the different stages of the co-op's maturity and where they source funding from. So that will be an interesting one to get some response to.
Yeah, and I think that's right. All those the different options are probably more appropriate at different stages. And with startups, and it's probably applicable to all sort of startups, no matter what sector they're in or what sort of organisation it is that most of the initial growth does need to be funded by equity of some form, and I suppose the concept is that those that have the most to gain out of it are most likely to put money in from the outset. So there's a saying that the initial investors are friends, families, and the last one being fools, which you certainly hope wasn't going to be the case. But it would be parties who will be the most sort of immediate beneficiaries. I suppose the option of looking at other innovative ways of funding assets, if that's what you need. And sort of accessing let's call it asset specific financing from it could be banks, but it might be other sorts of I'll call it credit funds or lending funds. Could be other sort of financing companies who look at different assets and say, right, well, at the end of the day, I've got an asset which I can finance, and if the startup for whatever reason can't manage it, I can move the asset somewhere else, and to a user who will be able to finance it. So yeah, less options when you're a startup. There's that's sort of absolutely the case. Doesn't matter where you are, but as the businesses grow, well, you do get access to debt facilities with a bit of track record. You can find other types of investors. I suppose what I've seen, which has been quite interesting to me, and when I look at our business, and we've got a whole range of I suppose investment opportunities which we present from time to time. And it's interesting that what I might have thought were, let's say, really conservative investors who we first became exposed to through their investment in commercial property or farmland or something which I'll put at the more conservative end of the risk spectrum, are also prepared to back early stage businesses on the back of a good strategy, I suppose a real market need, and the people that they've got confidence in the people, and maybe the people have done something similar before, or have just got a really relevant set of skills. So yeah, people do invest, let's say, right across the risk spectrum. So it's a matter of finding a way to access them, I guess.
That's great. Thank you so much, Ross. If there's no other questions, anyone got anything that they want to add at this stage? If not, we'll wrap things up. I can hear someone speaking very quietly. No, we can't hear you, sorry. No, I think that's, unfortunately, we can't hear whoever that might be. Yeah, Ross, I'd just like to thank you so much for your time. If there are any further questions, I'm sure that please do direct them through to us at Co-op Business NZ, and I'm more than happy to go back to Ross with the questions that you might still have. To hear from subject matter experts such as yourself is hugely valuable, and we really appreciate you sharing your knowledge and insights. For those of you wanting to establish cooperatives, which it doesn't look like there's many of you on the registration, most of you look like you're in well-established cooperatives, which is great. We're obviously always looking to expand the network here at Co-op Business NZ, and as all of you are aware, and all of you are involved in multiple sectors, so you do generate around 17% of New Zealand's GDP, and you are fundamental to the New Zealand economy. And I think we're seeing more and more of that recognition coming through. We're just about to release the PwC report to reconfirm that. And yeah, again, thanks everyone for joining us, and kia kaha.
Thanks, everyone.